very close, not as close as he was. That's okay. And so it's just going to go up a lot from here. We've hit that bottom and we're heading back up. Not just, yes, you're right, Julie, about the ticker in the past few weeks, but that's just the beginning of a much higher surge. So I feel very comfortable with my $10,000 announced call, which I made on your show and earlier, but we were not looking at peak gold or a meltdown. We were looking at these kinds of drawdowns that do happen, and now we've hit the bottom, and we're going much higher from here.
What do you think explains the move in gold? Does it have to do with geopolitics? Does it have to do with our fiscal picture? Is it inflation? What do you think? What are the forces that are driving it? And what's the narrative that you think is completely wrong out there that you're hearing?
Two really good questions. I'll take them separately. What's driving it? Kind of all of the above, but just to break it down a little bit, the central banks are still net buyers. Russia sold a little bit because they needed the dollars. But on net, central banks are still net buyers. So what that does, that by itself doesn't send gold to the moon, but it does put a floor under the market. Central banks are actually pretty savvy buyers. I hate to use cliches, but they buy the dips. They don't overpay, but other forces will drive the price of gold higher, but the central banks kind of keep it from going lower. So that's a nice asymmetric trade. You have, as a speculator, trader, and investor, you have the upside, unlimited upside, but limited downside. Those are my favorite kind of trades. So I would put the central banks at the top of the list. Inflation for now is less important than a lot of people think. Gold can be an inflation hedge. It's also a deflation hedge. During the Great Depression, from 1929 to 1940, but you can use different dating methodologies. But during the worst part of the Great Depression, when every price was collapsing, gold went up 75%. It went from $20 an ounce to $35 an ounce. So, but why did that happen? Well, we were on a gold standard, but gold standards change. And FDR raised the dollar price of gold. He didn't do it because he loved gold. In fact, he confiscated all the gold in the country. He did it because he wanted to get the price of everything else up. So a gold spike meant that corn, wheat, oil, mining, agriculture output, everything else went up. And that's what he was aiming for, because he was trying to break the back of deflation. And so what's the quickest way to get inflation? It wasn't money printing. I talked to Ben Bernanke about this, and Bernanke agreed, but it was not money printing. It was devaluing the dollar. See, when you say the dollar price of gold went up, which it did, what's really happening is the dollar's going down. I mean, if you need more dollars to buy your ounce, the dollar's worth less, and that is inflationary. So, the dollar price of gold went up, but what it meant was that they devalued the dollar relative to gold, and that devaluation triggered the inflation or stopped the deflation. So you can see a situation where we're in another disinflationary or deflationary episode today, because the inflation we're seeing is coming from the supply side, which tends to snuff itself out because people spend less. If you have to spend more for gas at the pump, you're probably going to spend less at Walmart or Target or eating out for dinner, buying new clothes, vacations, whatever. You're going to spend less somewhere else because real incomes are not going up. But gas at the pump is, and the demand is inelastic, meaning you have to buy it no matter what to, go to work or take the kids to school. But it's not a free lunch. That money you spend at the gas pump, it's going to come out of money that you might spend anywhere else. So that tends to be deflationary and actually cause a recession. So you may need to see the price of gold go higher to break that deflationary mentality. Now, the opposite is true. We might be at a tipping point where the inflationary vector moves from the supply side, which is the disruption, which we just talked about, over to the demand side, something called demand pull inflation, which is behavioral. Again, it has nothing to do with money printing and all this stuff. It has to do with consumer psychology. If anyone who bought a new house and is buying appliances, you're saying, gee, I'm thinking of buying a refrigerator, but if the price, I better go buy it right now because the price is going to be higher in 6 months. That mentality where you pull all your purchases forward, all your planned spending is pulled forward because you're concerned that prices are going to be higher if you wait. That feeds on itself. That is inflationary, and that's very difficult to break. You can't really do it with monetary policy. Except you're raising interest rates to 20% or putting the economy in a recession. So, and that would take the price of gold a lot higher. So, inflation can do it, but deflation can do it too.
This is where the gold argument becomes especially interesting. The discussion isn't simply about inflation. The bigger point is that completely different economic environments can create pressure toward gold. And that makes the next part of this conversation even more important. If you want more analysis on gold, the dollar, and the forces shaping global markets, make sure you subscribe and stay with us.
Based on the history, central bank demand is very strong. Mining output is flat. It's not collapsing. I'm not saying peak gold, but global mining output has been flat at about 4,000 metric tons per year, but it's been there for 7 years. So it's not collapsing, but it's not going up. And I invest in some gold mines, and I talk to people in the industry. It is getting more and more difficult, more and more expensive to find the high grade gold ore. So yeah, we're still mining, we're still producing gold, but that's not, output is not responding to the price increases because the mining side of it is so much more difficult. And your costs are going up, energy costs and so forth. So when you have flat supply and increasing demand, at least when I went to college, that means prices go up. That's supply and demand 101. So I'm very bullish on gold. For the reasons we just discussed, central bank buying, deflationary vector, inflationary vector, flat output, and just uncertainty. Now, the second part of your question was, what narrative are we disrupting or seeing, or what narrative do I perhaps disagree with? The narrative that's out there, it's been out there for a while, over a year, is the so-called debasement trade. And it says, the people are losing confidence in the dollar. The treasury market's going to collapse. Here comes the gold-backed Chinese yuan. Here comes the BRICS currency. Crypto's going to be the new king of the hill, etc. Get out of dollars. That's all nonsense. So I understand the rap. I understand the narrative, and it's powerful. A lot of people believe it. None of that is true. Let me just give you some concrete data to back that up. First of all, there's no such thing as reserve currency, right? So what do people say? Oh, the dollar is the leading reserve currency and euro is number 2, et cetera. There are no reserve currencies in the sense that central banks don't hold currencies. What they hold are securities. Now, the securities are denominated in a currency. Yes, that's true. But they actually hold bonds. So if you want to be the so-called reserve currency, what you really mean is you want to be the reserve asset, which is a government bond and specifically U.S. Treasury securities. So if you're China and you want to be the global reserve asset, show me your bond market. They don't have one. And I spent 10 years on the executive committee of one of the primary dealers. A primary dealer is a special kind of investment bank. You have normal investment banking functions, but it means that you get to trade with the Fed. When the open market desk at the Federal Reserve Bank of New York conducts monetary policy, so the policy set in Washington, the Board of Governors and Kevin Warsh with the Fed, but they actually carry it out at the New York trading desk. And if you buy Treasury securities, you're going to bid up the price and lower interest rates. And if you sell Treasury securities for cash, you're going to lower the price and raise interest rates. And that's how they do it. Well, if that's your methodology, which it is, you need dealers. You need someone to buy or sell with. That's a relationship that has to be approved by the Fed. There are only about 20 banks on that list. They call them primary dealers. But it's not even a license, it's a relationship. What it means is that you get to trade directly with the Fed. And my firm was one of those banks. We talk to the Fed every day. And this is back in the day when, it's still true, but at my time, during my time, there were no press conferences. There were no long statements. They didn't release the minutes for like 10 years. You didn't know what the Fed was doing. They didn't want you to know. And there were only two ways to find out. If you were a primary dealer, you could infer by the trading relationship. You knew from talking to the desk what they were buying or selling with certain securities on special. You got that information by actually trading with them. The other way to do it was have drinks at Harry's of Hanover.
What makes this especially significant is the contrast between the Fed of the past and the Fed investors see today. Rickards is describing a system where information was much harder to obtain and where relationships with primary dealers mattered enormously. But the bigger question is what happens when that old approach starts influencing the Fed again?
Bar, which is very close to the Fed.
I love Harry's.
Yeah, well, yeah. Well,
I used to go there all the time in New York.
Well, exactly. Go there after work. You can find out a lot about Fed policy. Now you don't have to because, they got press conferences and all that stuff. I mean, it's still good for drinks. But the point being, it was a very different Fed. Now, interestingly, Kevin Warsh is trying to go back to that. He can't go all the way, but he wants to get rid of these stupid dots. I talked to... I won't mention his name, but absolutely one of the top Fed insiders. His office in the Federal Reserve headquarters is like right next to the chairman, and he's been there for through Bernanke, Yellen, Powell. He's been there through it all. He told me privately. He said, "We wish we had never started the dots." So we started them. I should explain the dots. There are 12 Federal Reserve Bank presidents and 7 members of the Board of Governors. So that's 19 top Fed officials. And every other meeting, they give projections on interest rates, unemployment, GDP growth, inflation, et cetera, and they put them in a dot chart. So they call them the dots. And, you can do a regression, run it through the middle of the dots and figure out the average and give CNBC something to talk about. But the point is, it's silly. They're all wrong. There's no worse forecasting tool. I mean, their track record has been awful, and people put way too much weight on it. And anyway, Warsh has said all this. Everything I'm just saying, he said. So they're going to get rid of the dots. If he may, they've already cut down on the statements. The statements have gone from about 1,300 words to like 400 words, which is kind of where they used to be. I don't know if he'll get rid of the press conferences or not, but he's certainly going to say less. You're not going to hear as many speeches. So in a lot of ways, the Fed is becoming less transparent, but that's by design, number one. Number two, I think the most important change Warsh has made is he said, the markets have been following the Fed. We don't want the markets to follow the Fed. We think the Fed should follow the markets. So you guys are on your own, bid, offer the 10-year notes. We'll watch it. We'll see what's going on, and we'll act accordingly. But we're not going to pretend that changing the policy rate, which is a short-term rate, somehow affects the yield to maturity on a 10-year Treasury note. I mean, Greenspan came up with this cockamamie theory that the yield to maturity on the 10-year note was the present value of a 10-year strip of short-term rates, beginning with the policy rate, and then 1-year bills, 2-year notes, 5-year. You can look at all that and come up with a stream and present value it, and that was the yield to maturity on the 10-year note, which is complete nonsense. And then to the extent it was different from what that calculation would give you, they call it, what do they call that? The risk premium, which is also invented. I mean, the Fed, they invent this stuff and everyone's like, oh yeah, risk premiums are higher. No, it's just the rate. It's the market determines the rate on the 10-year note. But Warsh understands that. So he's like, let's shut up. Let them stop trying to lead the market, which we can't do very well anyway. Stop forward guidance because we're really bad at it.
And that may be the key takeaway from this entire discussion. The Federal Reserve is changing the way it communicates with markets, while investors are being told to pay closer attention to what the market itself is doing. And if that creates more uncertainty, then the impact may extend far beyond interest rates, especially for gold.
Let the market do what it wants. We'll watch it and we'll act accordingly. This is a whole new Fed. Now, I say it's a whole new Fed. It is if you've been watching the Fed for 25 years. If you've been watching the Fed for 45 years, which I have, it's very familiar.